Ladies and gentlemen, good day and welcome to the Q1 FY24 results conference call of the Phoenix Mills Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. We have with us on the call today the management of the company, being represented by Mr. Shishir Srivastava, Managing Director, Mr. Anurag Srivastava, Group CFO, and Mr. Varun Parwal, Group President, Strategy and Corporate Finance. Should you need assistance during the call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I would now like to hand the conference over to Mr. Shishir Srivastava. Thank you, and over to you, sir.
Good morning, ladies and gentlemen. We take pleasure in welcoming you all to discuss the operating and financial performance of the first quarter of FY24. We hope you've had a chance to look at the results presentation shared by us. It has also been uploaded on the stock exchanges as well as on our website. We will now take you through the key highlights of the results and will refer to relevant slides of the results presentations from time to time. We start with the operational update on our retail mall portfolio. Please refer to slide 3 onwards of the results presentation. Consumption in Q1 FY24 stood at 2,574 crore with a growth of approximately 18% over Q1 FY23. If we exclude the contribution from Phoenix Citadel Indore and Phoenix Palladium Ahmedabad, which were not operational in the corresponding quarter in the previous year, this growth in consumption would be approximately 9% over Q1 FY23. At Phoenix Palladium Mumbai, the lifestyle block has been closed for renovation from May 2023 onwards. Adjusted for the reduction of consumption from this specific renovation, Q1 FY24 consumption has grown by approximately 10% over Q1 FY23. Consumption was robust across categories in the fourth quarter. Fashion and accessories up 17% from Q1 FY23. Jewelry has continued its momentum with a 31% growth over Q1 FY23. Food and beverages are up 24% from Q1 FY23. FEC Multiplex Entertainment up 3% from Q1 FY23. This is promising considering the ramp-up from new movie releases expected in the running quarter. Gourmet stores and hypermarkets have come back with full recovery of supply chain and clocked 88% growth over consumption in Q1 FY23. Our retail collections stood at 614 crore for Q1 FY24. Moving on to slide 4. For the month of July 23, consumption stood at approximately 931 crore, demonstrating a growth of 15% over July 22. On a like-to-like basis, adjusting for malls which were not operational in the last year, that is Phoenix Citadel Indore and Phoenix Palladium Ahmedabad, growth has been approximately 6% on a like-to-like basis. Adjusted for the renovation of lifestyle at Phoenix Palladium Mumbai, the growth in overall like-to-like consumption was approximately 7% over July 22. Retail collections for the month of July 23 stood at rupees 210 crore. End of season sales this year started in June compared to July in the previous year. Also, heavy monsoons in the cities across Maharashtra, Ahmedabad, Indore and Bangalore through the entire month of July impacted weekday and weekend footfalls and consumption, especially in Mumbai. We expect some momentum to come in the remaining months of Q2 FY24 from some factors like strong content pipeline in Q2 with encouraging lineup of new releases which will continue from the pickup we saw in July 23, monsoon subsiding, the Independence Day weekend, Rakhi and Onam in July, followed by Ganesh Utsav in September. Independence Day weekend, Rakhi and Onam in August, followed by Ganesh Utsav in September. Please refer to slides 5 through 8 for an update on Phoenix Palladium Ahmedabad. 26th February 2023 marked our entry in Gujarat with the launch of Phoenix Palladium Ahmedabad. Slides 6 and 7 depict the images of the mall. We opened the city center to our patrons with a trading occupancy of 32%, which has steadily ramped up to 68% as of July 23. Trading density in the month of July 23 remains strong at rupees 1,064 per square foot per month, with new trading units becoming operational. We expect the ramp-up in trading occupancy to continue and touch approximately 85% by the end of Q2 FY24. The mall is currently leased at approximately 95%. Moving on to slides 9 through 11 for an update on Phoenix Citadel Indore. Phoenix Citadel Indore, which is the first retail asset in India to have received the IFC Edge Advanced certification, was opened to our patrons on 1st December 2022. Trading occupancy at the city center location has shown a steady ramp-up and now stands at approximately 87% in July 23 versus 42% at the time of launch in December 22. We have seen excitement picking up at Phoenix Citadel Indore with new stores opening in Q1 FY24 such as Clictra, One Exchange, Reliance Digital, Chroma, Smart Bazaar, Under Armour, Senco Diamond, Malabar, Inspire, which is an Apple reseller, food and beverage outlets such as Pizza Hut, Zero Degree, and Plated. We are going to further see addition of some gastropubs and F&B options in the coming months to enhance the offering. May I draw your attention to slide 12 onwards for an update on our upcoming assets. Mall of the Millennium at Wakad, Pune is on track to commence operations by Q2 FY24, and currently it has over 190 stores, which is approximately 700,000 square feet, which is under fit-out. The construction work at Millennium Towers, the commercial offices integrated with the mall at this mixed-use development, is progressing well, and these offices are set for launch in FY25. At Phoenix Mall of Asia, located in Hebbal, Bangalore, we have received the occupation certificate for the retail portion of the development. It currently has over 214 stores under fit-out, which translate to approximately 0.7 million square feet. Phoenix Asia Towers, which are the commercial offices integrated with the Mall of Asia mixed-use development. The lobby and common area finishing and facade work is nearing completion. The first phase of these offices of approximately 800,000 square feet is expected to be operational during the current financial year. At Whitefield, Bangalore, part of our Phoenix Market City mixed-use development, excavation and shoring is under progress for the expansion, which includes offices. We also plan to densify this asset by adding a retail area of about 200,000 square feet and a Grand Hyatt hotel with approximately 400 keys. The offices integrated with Palladium Chennai, we see considerable progress in the project. On the project, we have completed slabs up to the first 2 floors of the office building and are seeing expeditious progress. Project Rise at Lower Parel, Mumbai, forming part of Phoenix Palladium mixed-use development. All our requisite approvals are secured and construction has progressed. Our retail project at Kolkata, we have completed the excavation and moving on to the next stage of construction. For our retail project in Surat, we are at the final stages of approval and building plans have been submitted. Consultants for the various work streams have been onboarded and design development is progressing swiftly. We have received the height and ULC clearance as well. And fencing work for our luxury project at Alipur Residential is also complete. For our warehousing development at Sona NCR, we have received all the NOCs, including the road access permission. Land development work at site has commenced, and consultants across various work streams are finalizing the design development and working drawings. We now move to the financial performance of our retail mall portfolio, and I draw your attention from slide 26 onwards. In line with consumption, our retail rental income and EBITDA growth has also demonstrated a steady increase. For Q1 FY24, the retail rental income was 377 crore, up 17% compared to Q1 FY23. With increasing operational efficiency, retail EBITDA for this quarter grew by 19% and was at 387 crore compared to Q1 FY23. I now request Anurag to take you through the office, hotel and residential section and the overall financial results.
Thank you, Shishir. Good afternoon, everyone. I'll draw your attention to slide 30 to 32 for an update on our commercial offices portfolio. Our commercial office portfolio continues to see strength in leasing traction with gross leasing of about 1.76 lakh square feet during the period from April to July 23, of which about 0.88 lakh square feet were new leases and about 0.87 lakh were renewals. Weighted average effective net rental for the portfolio stands at about 90 per square per month. The total income from commercial office portfolio for Q1 FY24 stood at 45 crores, with EBITDA at about 26 crores, demonstrating a growth of about 11% over Q1 FY23. Collections for the quarter, including taxes, were approximately 51 crores. Moving on to update on the hospitality segment, please refer slide 33 to 39. The St. Regis Mumbai, the performance for Q1 FY24 was led by increased occupancy for the quarter at 82%, with ARR at about 16,500, which was up 38% from Q1 FY23. ARR for the month of July 23 stood at 14,191, up 29% from July 22. The total income for Q1 FY24 stood at 112 crores, up 34% over Q1 FY23. EBITDA for the quarter stood at 48 crores, demonstrating improved efficiency with a growth of over 50% over Q1 FY23. With programming of events in the coming quarters and update of various venues, we are hoping for the continued momentum for this marquee asset. Our hotel in Agra, Courtyard by Marriott, total income for Q1 FY24 was at about 11 crore, up 33% from Q1 FY23, driven by occupancy at 72% and ARRs at 4,408, showing a growth of about 18% over Q1 FY23. Moving on to our residential business, which is on slide 41. Sales in the quarter stood at about 135 crores and collections were 136 crores. Revenue recognized for the first quarter was 106 crores. This traction of demand in our luxury residential projects in Bangalore continued in July 2023 with sales of 94 crores, taking the April to July, the year-to-date number to about 229 crores. Moving on to financial results, please refer to slides 42 onwards. Some of the key highlights of our consolidated financial performance as presented on slide 44 are as follows. Income from operations for Q1 FY24 stood at 811 crores, up 41% over Q1 FY23. EBITDA for Q1 FY24 at 492 crores, up 52% over Q1 FY23. Reported profit after tax, after minority interest and after comprehensive income for Q1 FY24 at rupees 241 crores. On the cash flows, debt and liquidity position, which is in slide 45 onwards. In Q1 FY24, we generated about 545 crores of net cash from operating activities, and our operating free cash flow adjusted for interest outflow stood at about 450 crores vis-a-vis 254 crores in Q1 FY23 last year and 492 crores in Q4 FY23. During Q1 FY24, we continue to fund development of our assets and spent over 340 crores in capital expenditure. Debt on slide 48 onwards, consolidated gross debts, which stood at about 4,050 crores as on 30th June 23, showed a remarkable decrease of 523 crores since March 2020, which was the pre-COVID period. We have borrowed approximately 73 crores for last mile funding of construction of our upcoming malls in Wakad, Pune and Hebbal, Bangalore. These facilities will be converted to lease rental discounting facilities after start of operation within this financial year for optimizing the leverage position over these assets. During the same period, we have repaid approximately 60 crores of our outstanding debt on the operational portfolio. Average cost of borrowing is up 13 basis points to 8.87 in March 2023 from 8.74 in March 2023. Currently, our lowest cost of borrowing stands at about 8.5%. However, with loan refinance underway at Indore and Ahmedabad, we expect our borrowing rates to reduce in Q3 FY24 onwards. Credit ratings of several facilities have been upgraded by 1 or 2 notches, and now all of our facilities are rated between A- stable to AA- stable. Liquidity is outlined in slide 50. Our liquidity position as on 30th June 2023 was 1873 crores. This excludes amount remaining in unutilized OD accounts. At a group level, our net debt is about 2,177 crores and PML's share of net debt is rupees 1,629 crores. We are bullish on our business prospects, and with a strong balance sheet position, our focus is now on to deliver our under construction projects in time and judiciously deploy our capital to expand our portfolio. With this, we would close our opening remarks and we'll open the call for an interactive question and answer session. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask questions, please press star and 1. The first question is from the line of Puneet Gulati from HSBC. Please go ahead.
Thank you so much and congrats on good numbers. My first question is on your guidance, where you indicated last time that you're looking at double-digit growth on the consumption side and rental side on a like-to-like basis. How happy are you with what you're seeing right now, especially in the context that even if you look at broad numbers, the trading area seems to have gone up by almost 28%, while your rentals have gone up by 17%, and consumption by similar numbers. How should we think about the consumption growth and rental growth now?
Hi Puneet, thank you for your question. I would say that our goal continues to remain the same, to drive double-digit consumption growth. We are achieving that in a combination of addition of new assets and the same mall consumption growth. Yes, we would say that if you just look at it on a like-to-like basis and seeing this approximate 7% growth compared to the same quarter in the last year. But it's also important to understand that last year we had seen a substantial growth in the month of July, which was the post-COVID period. And I think, at that time the concerns everybody had was, is this level of consumption sustainable, or is this as a result of revenge shopping or otherwise? I think the consumers have shown resilience. You continue to see a 7% growth, and we hope that with the additions and the changes and the upgrades that we are making across all our assets, we are going to continue to see this inch upwards again to a double-digit growth. The trading occupancies across our malls will be will be at 95% or more by Q3. We are expecting that. And then, of course, we have Mall of Asia, Bangalore, and Mall of the Millennium at Pune, which will also open up in Q3, which will further add to that consumption growth. Today, in 4 months, we've seen a consumption growth of about 3,500 odd crore. And I think that should be certainly sustainable. And, of course, we are now heading into a high consumption season in the month of August through November, December, Jan, and even Feb.
Would it be a right observation that so far we've seen the consumption growth being attributed only to the increase in trading area growth?
I don't think it's mainly because of that. I think there is an inherent increase in consumption compared to last year, even for the same stores, when we compare same-store sale growth across the mall. And as we've explained in the growth contributors across categories during my opening remarks, and if you like, we can recap that. We are seeing same category, same-store sale growth also increasing, and contributing to the overall growth. Plus, there is some impact on account of the, like as we've illustrated for Phoenix Palladium Mumbai, closure of lifestyle has certainly impacted consumption. But when we adjust it on like-to-like basis, we don't adjust what is the secondary impact, right? Because visitors who go to the lifestyle store also visit other parts of the mall.
Right. Understood. And secondly, can you comment upon what are you seeing on the leasing for your upcoming office spaces, and what is the timeline that you're expecting in terms of leasing those office spaces as well as the commission over the upcoming year?
So the approximately 800,000 square feet of offices that will go live this year at the Mall of Asia development, we are expecting to see executing our first deal in the next few weeks. In fact, we are waiting the part OC for that building to come through before we can go ahead and execute. There's a strong lineup. In fact, the pipeline that was built was close to about, I would say about 2 million square feet of pipeline that was built. And we are seeing demand for front office being, coming back, and I think there's a lot of curiosity and interest for people, for existing tenants at other office buildings where their tenure is coming up to an end to move. So there's a lot of interest for the new development for sure. But I think we should have this conversation perhaps in the next quarter when we'll be able to report some deals that we've done.
Understood. That's helpful. Thank you so much. I'll come back in the queue.
Thank you, Puneet.
Thank you. The next question is from the line of Pritesh Sheth from Motilal Oswal. Please go ahead.
Hi, thanks for the opportunity and congrats on great numbers. First is on margins, where I think since last 2-3 quarters we have been ramping that up quarter on quarter. Now, as you said, I mean, trading occupancy, which is probably at 89%, 90% across the mall portfolio right now, which will go up to 95% in next couple of quarters. How should we think the trajectory of margins from here on?
Anurag this side. I think margin improvement, as you rightly said, some of it is related to a strong operating performance and a significant increase in terms of people visiting through their vehicles, etc. So parking and other services like marketing, event signage, etc. They're all adding to the margins. The other important part is with improving of the trading densities, the common area gets apportioned over a lot of operating stores, so that increases the margin. I think we are moving towards once we hit a 90-95% of trading occupancy. That's where the true margin trajectory will go, and after that it will be linked to I think specific operating performance. Right now EBITDA is at about 102 to 104% of rental income, and I think this is a sustainable margins even for the new malls which we are constructing. The second part of this is on the hotels, where I think the strong ARRs, you've seen the ARR increasing significantly in both St. Regis and Agra. So that sort of increases the hotel margin over last year. So over the same cost base, we are able to increase our profitability. Offices occupancies have picked up. I think we've seen a net addition in the rented space in office. So there again, the apportionment of common areas, etc., is giving us better margin.
So another, maybe 100-200 basis point increase in this is possible because of share coming from the trading occupancy growth.
I think we can say that. The numbers, though, I don't have the exact numbers mapped out, but yeah, I think that seems to be the trend. Sure. Between 102 to 104 is what we have said is where we will, I think where this will stabilize and we'll see a organic growth afterwards.
Sure, got it. That's helpful. And, Ahmedabad this quarter contributed really high in terms of rental income. Rentals were also at 150. Was there some unusual? I mean, maybe some previous months rents getting accrued now because stores are opening up. How should I look at it?
Hi, Pritesh. Varun this side. So I think one thing you should consider is that Ahmedabad is a premium and a luxury development compared to say an Indore. So Indore average renters would stabilize in the range of 87 to 90 rupees, whereas Ahmedabad renters would stabilize at a range of 145 plus. So we did see trading occupancy going up sharply during this quarter, and we expect Ahmedabad to continue ramping up over the next 2-3 quarters as well, such that by quarter 4 it would be at 92% and above of trading occupancy. While it is a smaller sized asset than Indore, Ahmedabad is only 750,000 square feet of GLA compared to Indore, which is 1 million square feet. The average rent at Ahmedabad is much higher than at Indore, and hence it will contribute more in rental income compared to say an Indore.
Sure. So basically nothing unusual about this quarter. This is how we should look at in terms of rentals per square feet and rental contribution coming from Ahmedabad, right?
Yes.
Okay. Great. That answers my question. Thank you for answering. All the best.
Thank you.
Thank you. The next question is from the line of Kunal Lakhani from CLSA. Please go ahead.
Yeah, hi. Good afternoon. So firstly, just a follow-up on an earlier question. Shishir, so once, like, say, trading occupancy stabilizes at, say, 95% from, say, Q3 onwards, what kind of same-store consumption growth would you expect?
Wow, Kunal, that's a tough question to answer like this. I would just say historically we've always seen 10-12% same-store sale growth. We are hopeful that we'll be in that early teens, early 2-digit growth.
Sure. Okay. Just coming to the rentals, right? Now, we've seen that in the last 1 year or so, rentals increasing by, say, anywhere between, say, 4 to 6%, average rentals, YOY. Is this something that one should expect going ahead also? I'm talking about average mall rentals.
That would be a fair assumption, I would say. But let's also see that there will be some impact on account of the retailer mix change. So for ongoing contracts, etc., that would be a fair assumption. 6-7% would be fair. But with the change in retailer mix, that the base will increase initially. As you know our model, how the minimum guarantee in the first few years is much higher, then the revenue share component kicks in and takes the overall rental even higher. So we expect to see some changes on account of that. We have quite a few good brands coming in. In Kurla, we are opening Armani, we are opening Tim Hortons, Blue Tokai, and of course Uniqlo in October. There are similar brand mix changes that are being undertaken at Pune and Bangalore as well.
Sure. But like when I try to correlate this, right, 10 to 12% same store growth, and then 6 to 7% average rental growth. I mean, even if there's a revenue share kicking in, technically, right, and in long term, right, your average mall rental growth should kind of fall in line with your consumption growth, right? Like the way you work out your resets, right? So, is there some disconnect there? No.
So, see, we've had, as you are aware, we've had churns in the last year across centers, right? So when a churn happens, the minimum guarantee moves up. So while same-store sales growth has increased, the revenue share component over the increased minimum guarantee on account of these new contracts has just about started kicking in. We are seeing that additional contribution of rev share over MG at Kurla, that has already happened. We're going to see that at other centers as well. So there is a direct correlation, but there's a trailing effect because at the start of the contract, the MG is high. As the trading density of that store picks up, that's when the revenue share component goes beyond the minimum guarantee and the contribution starts moving up.
Sure. My last question was on the debt side. We are generating enough OCF, and which is funding our interest as well as our capex. Would this be the peak debt level, you think, or with the kind of OCF that we are generating and plus the new malls kicking in from this year onward, will this be the peak debt, you think?
Peak debt in what period of time is the question. I think as we add on more malls, etc., we have stated in past many times that our strategy is that we don't borrow on an under construction asset unless there is a line of sight available for opening the asset, which usually comes in between 6 to 9 months. Once the asset is operationalized, we would like to borrow on that asset because it gives us various advantages. It releases the capital for further deployment, and we have, while we have very robust operational cash flows as well, but we would like to release our equity in some projects to deploy new projects. And as long as the operational asset supports that debt, we are fine to borrow within conservative limits. So I don't think so. This will be a peak level of debt. We may add LRD debt in few of our assets. Yeah.
Sure.
If I may add to that, Kunal.
Yes.
If I may just add one point to that. See, if you look at our interest cover, it's almost 5x, right? So our EBITDA is almost 5x of the interest cover. We used to be at 3x, and now, of course, we are seeing a higher EBITDA margin. So we are seeing that number, and we've paid down debt. So there is a lot of elbow room. I think we are going to always use that as a measure of, how we want to be placed in terms of drawing down further debt. And as Anurag explained, we will be drawing down further debt on operational assets and make sure that we have enough elbow room on account of this interest cover and borrow probably much lower levels of construction finance.
Got it. Yep. Thank you.
Thank you. The next question is from the line of Mohit Agarwal from IIFL. Please go ahead.
Yeah, thanks and good afternoon, everyone. So my first question is, in your opening comments, you gave some numbers around the category-wise growth. So jewelry, F&B, premium grocery and hypermarket doing very well. How do we connect those numbers with the overall numbers that you reported for July 7%? So what are the key laggards there, if you could give some color on that? And are there any, post-COVID, how these categories have been doing, are there any learnings that you want to, or are you applying that to the new leasing that you're doing in the under-construction malls?
Let me answer the last part of your question first. The learnings have definitely translated in a slight change in the category mix, I would say, to some extent. But contractually, the business model structure, I don't think that there is any structural change to that. In fact, we are back to where we were pre-COVID, and neither do our retailer partners expect much of any structural change to the overall contractual terms or the commercials. Your question pertaining to July 23, I think the information is a little raw for the moment, but we've seen, just give me one moment. Let me try and pull out some information for you. Yeah, we're still, the numbers are a little raw, so I would hesitate to try and put percentages in terms of growth across categories. But specifically on entertainment and FEC, when you ask that, I think July numbers are very, very high compared to last year for the month of July. The growth is quite high.
And just a couple of clarifications. So what would be the laggard in this month? And also you mentioned about the slight change in category mix in new leasing. If you could elaborate on that.
For July, I'm unable to give you an answer on this on the laggards because I think we'll cover it in the next quarter. And as I mentioned, the information at this stage is still a little raw.
Sure.
But if you look at Q1 FY24 versus Q1 FY23, you can see that electronics and multiplex were up about 2% and 3% approximately. Here, this is where I think we hope to see some growth in this ongoing quarter. In terms of the category mix, we have, I think this is something that we have stated right from 2022 when we reopened our malls, that we have taken fashion up, we have taken jewelry as a category up, we've taken food and beverage as a category up in terms of the overall square footage. So fashion and accessories typically are seeing about 55% of the trading area today. Jewelry is still at 1%, but it contributes 11% of consumption. Food and beverage is at about 9 to 10% depending on location to location, and it contributes about 11% of the overall consumption.
Okay, perfect. And my second question is on the business development. So what is the outlook like there, and any challenges that you may be facing in terms of availability of land parcels or, the prices going up very high? So you could give some color on that as well.
I think we have a very strong pipeline, which we should be able to announce hopefully something in the next quarter. But we do have a strong pipeline across different geographies, different markets in the country. Yes, of course, there are challenges in finding clean, clear land with no title issues. Price expectation has moved up, but I think we are still being able to find land parcels which really will fit well within our mandate and our overall return expectations.
Okay. Any color on what kind of additions you could do this year? Any indicative pipeline?
I'm sorry, but at this point in time, I won't be able to, share that information, Mohit.
Sure, that's fine. Thank you so much. Those were my questions.
Thank you. The next question is from the line of Biplab from Devrama. Please go ahead.
Good afternoon, and thank you for taking my call. So, sir, my first question is on the retail, on the office, under construction office. So we have seen that in the past, in the retail malls, under construction retail malls, you are significantly pre-leased much before the mall became operational. Whereas for office, we have not started leasing significantly. So just trying to understand, is there any strategy different for office and office versus mall? And intuitively, would not it reduce significant leasing risk if we pre-lease in advance in office too?
I think the nature of the product is only very different. Typically in a mall, when you launch the mall, even before you break ground, you end up doing some kind of pre-leasing to large anchors, which set the tone for the brand mix, etc. And retailers can take a look ahead of 4 years because they know their expansion strategy across geographies. In offices, RFPs come out typically maybe 6 months prior to the intended date of occupancy. So while a building is under construction, in very few cases is one able to do a pre-lease unless you do a build-to-suit requirement, which are very few, not too many in numbers. Also, if for front office spaces, which is what we are building, the sweet spot we are seeing is in the range of about 30 to 50,000 square feet in terms of demand. Now that's the kind of demand that comes typically 6 months prior to the actual need.
Okay. That's good enough. And sir, what kind of rentals do you expect in this upcoming office spaces like in Whitefield, Hebbal, Walker, and Chennai?
We have we had underwritten our returns or our business plans for Hebbal, which is the office building which is going to become operational in this financial year. We had underwritten that at the range of, if I remember correctly, about 65 or 70 rupees a square foot. We expect to lease higher than that for sure.
And what about the other offices in Walker, Whitefield, and Chennai?
So Walker will also be in the range of, we expect to outperform the business plan, but we would expect to be in the range of about 80 rupees or thereabouts. Whitefield is a little far out in terms of the project completion. So at this point in time.
And Chennai?
Chennai should be in the range of, again, 65 to 70 rupees. Today's rental in that micro market.
Okay, and one final question, just curious to know, sir, when you start looking at a land deal and initial after preliminary evaluation, and you have shortlisted based on the preliminary information, you have shortlisted a land, and from there to finally doing that agreement, definitive agreement, and you closing the deal. Typically, is there a ballpark number, X or one year, 1.5 years, 6 months? Is there any ballpark number, or it varies from location to, significantly varies from location to location? And
it varies, no? I mean, if it's a simple, straightforward, clear land title without requiring any statutory governmental approvals, etc., one can complete the transaction, and we've done it in the past in 3 months also. So when we acquired Hebbal, that was concluded in less than 3 months. But there are typically, if there is a government auction, then you conclude it in between 1 to 2 months. If there are transactions which require land use conversion, etc., then the timeline can be anywhere between 6 to 9 months.
And what takes most of the time? Is it title due diligence or negotiations on the valuation or post agreement? There are like
title due diligence is anywhere between a 60 to 90-day process. And like I mentioned, the timeline varies on account of other aspects depending on statutory approvals, if any required for transfer of a land use conversion if it is required.
Okay. So mainly approvals, and it depends from.
You may take that away from this conversation.
Oh, okay. Okay, sir. Thank you.
Thank you. The next question is from the line of Ashwini Kumar Agarwala from Edelweiss Mutual Fund. Please go ahead.
Good afternoon, sir. I've got a couple of questions. Can you tell me that the broader inflation is roughly in the range of 6%, whereas our retail consumption is in the range of 6 to 7%. So how do we see the value, the actual real growth coming in? And from this 7% also, the jewelry part really did very well, and that was aided by a 15% jump in the gold prices. So how has been the overall footfalls, ticket size purchase per person, and do we see real growth coming in?
I would say that the footfalls would have, certainly footfalls are back to the pre-COVID levels now. The ticket price has probably, been marginally impacted. If your question is, are we going to expect to see consumers spending a larger wallet share during their mall visits, I think that is what we are working on by way of improved category and brand mix and upgraded offering and newer products in our mall. So that's always the goal, to certainly outbeat the inflation. And we have consistently done that for the last 20 years. And I think it's just, there's no long-term impact in our opinion, but it requires probably an upgrade and meeting customer aspirations on newer brands and newer categories.
Okay, and another question. I've got a few questions. So if you see the last Diwali or the last festival season had a lot of pent-up demand because people didn't celebrate the festival for 2 or 3 years. Now this would be a normal year. So do you see real traction coming in this festival?
Are you planning to spend more this Diwali? I hope so.
Not really.
I would hope so. See, again, when last year's performance, there was speculation whether it is revenge shopping and pent-up demand for the full year. That was the question that we have. I think this Q1 is giving us the confidence that that consumption, while it may not have grown the way we would have liked it to, there is certainly a growth, and it was not a not an interim spurt of consumption that we saw. This time Dussehra is in October, Diwali in November, Christmas in December. The celebrations are also more spread out, so logically one would hope that we can get more of the consumer wallet share.
Okay, and so now if I come to the financials, so post-COVID we had a round of price negotiation where we had a significant price increase or the rentals increase. Now what's the kind of rental increase which you expect in the next 1 year or 6 months, especially from the ongoing current malls?
See, I'll try and answer this question slightly differently, okay? If you look at rent collection on consumption, I think that's a good measure to understand where we are. This quarter we've been at approximately 14-odd%. In malls where consumption continues to grow, trading density continues to grow up higher, you have the ability to push this number even higher. So, for example, at Phoenix Palladium, Mumbai, just give me one moment. So Phoenix Palladium, which is, our flagship mall in Bombay, where trading density is approximately at about 3,800, 3,500 to 3,800. There typically the cost of occupancy, which is rent on sale, can be as high as 17% as well. So as the mall consumption moves up, you have the ability to take up your rental received, because the margins are higher and the retailers can afford to pay that higher rental.
Okay,
so we are. I beg your pardon?
Apart from Palladium, in the other malls, because Palladium is quite concentrated.
Bangalore this year, if you compare Bangalore's growth, rental growth, this year you will see that Bangalore has really outperformed in terms of consumption in this quarter, and our rentals have started to show an improvement, and currently we would be at approximately we would see a 9% rental income growth over there. 4%.
Okay, sir. Thanks a lot.
Thank you. The next question is from the line of Nimit Gala from Ace Lansdowne. Please go ahead.
Hello, can you hear me? Hello?
Yes, we can hear you.
Hi, thanks for the opportunity. So just wanted your view on the leasing trends. Currently, if I see for the current quarter, commercial leasing has been quite strong. So, would you be able to provide the verticals from, which these tenants are from? And the second is, I remember you did mention about being extremely selective in the residential. So, just wanted your thoughts on expansion plans beyond Bangalore or Kolkata for that matter.
May I request you to repeat your question? There's a lot of background noise.
Okay, can you hear me now?
Yes, please go ahead.
So firstly, on the leasing trends, commercial leasing trends, I see that the commercial leasing has been quite strong in the current quarter. So would you be able to provide the verticals from where these, the tenants are? And secondly, about the residential, I remember you being, mentioning in the last quarter about being extremely selective in the residential segment. So just wanted your thoughts on the expansion plans beyond Bangalore or Kolkata.
Okay, on commercial leasing, I think you can connect with the team to get a breakdown on which sectors the occupants have come from.
Okay.
We have seen about 76,000 square feet of rental in this first 4 months of this financial year. Just to name a few, I think we have Adani, Indigo, JSW Steel, Bajaj Group in Pune. So you can get a detailed list from our IR team on that subsequent.
Sure.
In terms of residential, we are, as we mentioned in the past, we are only looking at opportunistic situations today, where we have the ability to acquire a land parcel at an established market where the established rates are high. So at present, we're not actively going out to look at growth in that in that space, but we're going to continue to look at opportunities where the returns expectations are high and where we in established and mature residential markets.
Understood. That is helpful. Thank you.
Thank you. We'll have to take that as the last question. On behalf of the Phoenix Mills Limited, that concludes this conference. Thank you for joining us, ladies and gentlemen. You may now disconnect your lines.